the biggest American bank, is warning about the financial and investment crisis in 2025. Bank of America, one of the world's largest financial institutions, has just released a report explaining why growth and tech stocks are in a bubble, why the S&P 500 is also in a bubble, and how these situations resembles past bubbles like the dot-com crash of 2000 and the Nifty 50 bubble over 65 years ago. They even claim the S&P 500 could drop by as much as 40%. That's a terrifying number. A 40% crash would wipe out trillions of dollars in market value, devastate retirement accounts, and send shockwaves through the global economy. If you own stocks or ETF, this is something you can't afford to ignore. But here's the thing. Market crashes don't happen in a vacuum. They are often preceded by warning signs, shifts in economic policy, and behavioral changes among investors. So the big question is, are we actually on the verge of a collapse, or is it just another case of fear-mongering? Let's break down this information, put it into context, and figure out if investors should really be worried. We've heard warnings like this before. I've been investing for years and I've seen countless predictions on financial collapse. Some experts like Michael Burry, yes, the guy from The Big Short, and Jeremy Grantham have predicted dozens of crashes in the last decade. And yes, despite all those warnings, the market has mostly gone up. But this time it's different. This warning isn't coming just from a lone investor. It's coming from one of the fourth largest banks in the world. Banks have access to more data than regular investors, including insider business activity, corporate debt levels, and macroeconomic trends. When they issue a serious warning, it's worth paying attention. The last time we saw banks issue a major warning was in 2007, just before the great financial crisis. Back then, early reports about the housing bubble were dismissed until it was too late. Could this be another moment where we look back and wonder why we ignore the signs? So let's dive into the details and see what's really going on. Bank of America claims that growth stocks are in a bubble. For beginners, stocks are often categorized into growth stocks, value stocks, and dividend stocks. Growth stocks like Google, Microsoft, and Nvidia are companies that expand rapidly and tend to be more volatile. In contrast, value stocks like Coca-Cola or Johnson & Johnson are more stable but grow at a slower pace. In the past 3 years, growth stocks have skyrocketed. Nvidia is up over 1000% in 5 years. Apple and Microsoft are at all-time highs, and while these companies are making billions, their stock prices are often growing faster than their earnings. This is exactly what happened in previous bubbles. The market got ahead of itself. Bank of America argues that today's rally is unsustainable. They compare it into the Nifty 50 stocks in the 1970s, big blue chip companies that everyone believed could never fail. But when the economy turned, those stocks collapsed, wiping out naive investors who believed in buy and hold no matter what. One key argument is this chart. It shows the US stock market's share of global market capitalization. Historically, when US dominance peaked, major market corrections followed. The Nifty 50 bubble, the dot-com crash, both were preceded by periods of extreme concentration in the market. And today, we are seeing the highest concentration of US stocks in 75 years. Another concerning sign is that just 5 US companies, Apple, Microsoft, Amazon, Nvidia, and Alphabet, now make up over 26% of the entire S&P 500. For comparison, during the dot-com bubble, the top 5 companies accounted for about 18%. This is risky because when a handful of stocks drive the entire market, a downturn in just one or two of them can drag everything down. If AI hype fades or interest rates stay high, these giants could tumble and take the rest of the market with them. A major factor in today's market boom is artificial intelligence. According to Bank of America, AI stocks now make up over 55% of the S&P 500's market capitalization. This is similar to the internet boom in 2000 when tech stocks dominated the index before crashing. But is AI really just another bubble? The reality is that AI is driving massive productivity gains. Companies like Nvidia and Microsoft are showing real revenue growth, unlike many unprofitable tech firms in the dot-com era. However, even if AI is the future, the question is when these companies will justify their sky-high valuations. Investors tend to overestimate short-term impact and underestimate the long-term potential. Consider this: AI stocks are experiencing explosive growth, but so did internet stocks in late 90s. Amazon, for example, was once labeled as a bubble, but those who held through the volatility are now sitting on massive gains. The key difference is figuring out which companies are truly positioned for sustainable success versus those riding the hype. Bank of America also warns that when past bubbles popped, the market stagnated for years. The dot-com bubble led to what some call a lost decade, where stocks remained flat for an extended period. Could history repeat itself? Well, here's the thing. Even during lost decades, investors can still make money. The 2000s were brutal for the S&P 500, but those who invested in dividend stocks, international markets, or sector rotations did fine. For example, during the dot-com crash, consumer staples, healthcare, and energy stocks performed well. The lesson? Smart investors don't just follow the hype, they prepare for different scenarios. One of the most interesting pieces of data from Bank of America is that fund managers are fully invested right now, holding the lowest cash reserve in 15 years. Historically, when managers were this confident, markets were at risk of a downturn. Yet, let's not forget, just 2 years ago, many of these same experts predicted a recession that never happened. The market defeated expectations and went up instead. Those who listened to the doom and gloom missed on huge gains. So is the market in a bubble? The data suggests that valuations are high and concentration in a few mega-cap stocks is concerning. But it's also true that AI-driven companies are generating massive profits and past warnings of crashes haven't always come true. Here's my take. Rather than making emotional decisions, focus on a balanced strategy. If you are worried about a bubble, consider diversification. Look into dividend stocks, international markets, or even bonds. If a crash happens, be ready to buy quality companies at a discount. At the end of the day, the best approach is to stay informed, diversify, and stick to a solid investment strategy. If you want to learn more about how to navigate markets in uncertain times, check out my other videos where I break down smart investing strategies. Do you think the market is in a bubble? Let me know in the comments below.